One of the most frequently asked questions I get in my DMs is, I finally have $10,000 saved up, what should I do with it? Well, simply put, you would either save it, invest it, or do nothing with it. But obviously we're going to dive a little bit deeper than that in this video. I'm hoping this video will serve as the ultimate introductory guide for you. Hey guys, this is Jenga and welcome to my finance corner. A lot of what I'm about to cover in this video comes from personal experience and just tons of research, so you don't have to. Oh, and if you have a quick second, give my video a thumbs up. Alrighties. Now, according to a recent survey by Go Banking Rates, about 13% of respondents say that they have more than $10,000 in their savings. If you're a part of that 13%, congrats to you, give yourself a pat on the back. Now that you've worked hard to save that $10,000, it's time to get your money working for you. Now, I'm gonna unpack a lot here while keeping it concise, so get out a pen or a paper if you need to and listen up. Now, when you look at your money and your net worth, you can think of it like you're building a Jenga tower. And the blocks on the very bottom should be there, strong and sturdy, to ensure your financial stability as you make more money. They're kind of like the prerequisite courses that you have to take before you advance to the next level. So at the base level, aka this is where all your money should go to first if you don't already have these accounts. First things first, before we think about growing money into more money, we should also think about owing less money if you have any debts. So that means paying off all of your credit cards and loan debts, starting with the highest interest ones first. Quick little note, if you have a mortgage plan, increasing your monthly payments may save you more money in the longer run as well. Now, let's say you are debt-free. Again, congrats. Then I want you to check, do you have an emergency fund that is cash liquid? Meaning that you're able to withdraw money from this account whenever you need in case of an emergency. A good rule of thumb that people follow is that you should have enough to cover 3 to 6 months of your living expenses. Personally, I have my emergency fund set up in a high yield savings account, aka HYSA. Again, put a big fat star next to this if you're taking notes. For those that don't know what an HYSA is, it is exactly like your regular savings account, except you're earning 4 to 5% in many cases of monthly interest. A lot of banks and online banks provide really high competitive APY rates. Quick example, Wealthfront, SoFi, Ally Invest, all are very good online banks that offer high APY. Trading apps like Robinhood and Public also offer up to 5% with the cash that is sitting in your account that is not invested. So these are all legit accounts that you can look into opening for free. Okay, let's take a quick look at the Jenga tower. Now that we got all of our debts sorted out and we're saving enough to cover all of our emergencies, now we can look into investing. When it comes to investing and growing your money, depending on your risk tolerance, your timelines, and what goals you're setting, there's a couple of options out there for you to consider. We'll start from the longer time frame, the sort of slow and steady wins the race type strategy, and then we'll look at the shorter term, more high risk, high reward type options out there. On the longer time frame, first, you should max out all of your retirement accounts. So whether that's your employer matched 401k or your individual Roth IRA or both, here are the new 2024 contribution limits. Max that out because that money is going to grow tax-free. Now, I'm not going to go super in depth on how these retirement accounts work. Feel free to Google them yourself. But one thing important to highlight, your work does not end by just successfully depositing the money into your retirement account. You have to actually go into the account, then invest that money into some financial vehicle. So with 401ks, there's all these target funds that you can choose to invest your money in. For your Roth IRA, you can invest in ETFs, index funds, or individual stocks, which we'll go over a little bit more in detail later in the video. Next, I want to bring your attention to Treasury Bills. Treasury Bills, otherwise known as T-bills, are U.S. debt securities that mature over the time period of 4 weeks to a year. T-bills are a shorter-term financial instrument issued by the U.S. Government Department of Treasury. T-bills can be bought directly from treasurydirect.gov, or certain brokerages also have the option for you to directly purchase T-bills through their app. And currently, at the time of this recording, T-bills are yielding over 5% per month, very similar to a high-yield savings account, if not higher. An important thing to differentiate between T-bills and a high-yield savings account, while both yielding around 5% per month at the time of this recording, T-bills are generally held until a maturity date, meaning it's not as cash liquid as your HYSA. However, some holders may wish to cash out before maturity and realize the short-term interest gains by reselling the investment in a secondary market. Now, the biggest reason you might choose to buy T-bills instead of saving it in a high yield savings account is because the interest income that you make from T-bills is exempt from state and local taxes. But it is still subject to federal income tax, but you're saving a little here. There are other options such as Treasury bonds that you can look into as well that I will not go into detail in this video. But to access more detailed information, feel free to head directly to treasurydirect.gov for more information. This video is sponsored by public.com, and I'm super excited to partner with them and review their platform with you guys. Launched in 2019, Public is an investing platform on a mission to make all public markets work for all people. You can build and diversify your portfolio with stocks, options, bond, treasuries, ETFs, and more. To stay relevant within the scope of this video, I wanted to take this opportunity and go through some of Public's investing features. First, I want to highlight the 6-month T-bills feature that I personally have been using in the past few months. If you go to the Public app, hit Trade, and you'll see a menu of different features you can choose to allocate your money to. The 6-month T-bills are actually returning 5.41% at the moment. If you want to invest in T-bills on Public, you can tap on the bubble and invest whatever amount you're comfortable with. If you want to further customize your investing strategy based on your risk tolerance, Public offers an investment plan feature where you can select and build your own investment plan. Whether it's aggressive, moderate, or conservative, or AI-focused, dividend growth focused, or you just want a piece of all the top ETFs on Public. And lastly, if you have any extra cash lying around, you can earn a 5.1% yield on that cash with Public's high yield cash account. There's many other financial vehicles you can explore on the app as seen in the menu, so be sure to check Public out. So if you're ready to invest, trade, diversify your portfolio, or you just want to be part of a bigger community of like-minded traders and investors, click the link in my description to get started. All right, let's get back to the video. Next, if you're planning to have kids and want to start saving now, you can start a college fund with a 529 plan. Now, why would you do that? As you guessed, gains on money invested in a 529 plan is tax-free, as are the withdrawals when the funds are used for college or educational purposes for your future child. Now let's say you're a little bit older and you don't have the best health. Then you may want to look into opening a health savings account or HSA. Like a 401k, you won't be paying taxes on the dollars you contribute to the plan. Even better, qualified withdrawals due to health concerns are also untaxable. The only drawback here now is the contribution limit. It has gone up in the last couple of years, and in 2024, that limit is $4,150. And if you're 55 and older, you can contribute an additional $1,000 as a catch-up contribution. I personally have just the regular health insurance and don't contribute any of my money towards an HSA. Okay, now for the more medium to shorter time frame investments. You can always open up an individual stock portfolio with any major brokerage. Like I mentioned earlier in the video, a lot of stock trading brokerages also have a high yields cash account option, which essentially means all the money that you're not using to invest in stocks or ETFs will automatically be put to work in their high yields cash account, and you're going to be earning around 5% per month. However, the only thing that I want to add, of course, with any financial platform, whether it's a bank or a brokerage, they're all becoming more and more well-rounded with the options they offer, because ultimately they're competing for your attention and your money. But for my personal sanity, sometimes I like to keep certain accounts separate, especially if they're on different time frames. So I would like to keep the money that I save for emergency purposes in a separate account than my short-term investments for, say, just a stock trading portfolio, if that makes sense. Because even though they also offer a high yield cash account option, the convenience of having everything all in one app might not necessarily be the best, because you might just accidentally transfer money easily from a more conservative position to a riskier position, if you get my drift. But I digress. Going back to your individual stock portfolio, the more conservative option you'll hear people preach is to only invest in index funds or ETFs, like SPY, NASDAQ, Vanguard, QQQ if you're into tech, as these give you a diversified exposure to an asset class. For example, SPY tracks the top 500 companies in the US, or if you want to diversify your portfolio into, say, real estate, you can then look into REITs. If you have a higher risk tolerance, or maybe you just have more of an in-depth expertise on a specific industry or sector of the market, you can then look to trade singular companies. For example, when ChatGPT came out, I put more money into Microsoft because they were a big shareholder of OpenAI, and that was kind of my thesis for investing in Microsoft. Of course, there's a lot more to trading and investing, and sometimes it's very hard to time the market, so it's more important that you just spend a lot of time in the market, meaning that maybe it's better to contribute a portion of your income every month, every week into the stock market and buy a plethora of stocks that you have high conviction in. And shameless plug, if you want to learn more about trading and investing, I have created a Discord called Loki Stonks that we are going into year 4 of now. In this this server, we have weekly workshops and educational resources. So if you wanted to join a community of like-minded investors and traders, or if you just wanted to learn more about the financial markets, I'll drop a link in the description. But the downside to investing in individual stocks is akin to putting all your eggs in one basket or betting on the wrong horse. Hence why, again, you always hear the phrase, you need to diversify your portfolio into different asset classes. And again, a general rule of thumb that I like to apply is to look at your total net worth, and let's say that's $10,000. If I was conservative, maybe 80% of that is going into my savings and more low-risk investments. If I was more aggressive, maybe I'm going to be putting, 10-15% into crypto, or some people who are even more aggressive and really believe in crypto, for example, might put in 50% of their assets into crypto. Other people might think that's crazy. So as you see, how you want to save, invest, or grow your money all depends on your risk tolerance, your timeline horizon, and goals you want to reach in the short or near term. But seriously, if there's one thing you can take away from this video, please don't let your money sit in your regular checkings account earning pennies. The least you can do is spend literally 5 minutes to open up a high yield savings account so your money can really start passively growing month over month thanks to compound interest. Okay, to summarize this video, the above options were ways to grow your money based on the priorities that you currently have in the state of your life. Do you need to clear debt first? Already cleared it? Great. Are you saving for a rainy day? Already have money in high yield savings account? Great. Now, are you trying to save for retirement and do you have your retirement accounts maxed out? Yes? Great. Now, if you still have money left over, now you can diversify your portfolio more and adjust for risk while closely watching the markets and being in tune with the economic landscape. Whew, okay, I tried to unpack everything in one video. I hope that was helpful. Please do your own due diligence on the fees and limits on each of the investment vehicles that I mentioned above. None of this is financial advice. Please contact a professional. This video is only for educational purposes. Thanks for tuning in. If you want to continue supporting my content, I would really appreciate a thumbs up. Comment any questions you have. I also want to know what sort of investing strategies you guys are currently implementing to reach your goals. Be sure to follow me on all other socials and of course subscribe to my YouTube channel. This is Jenga and I'll see you in the next video.